Virgin Galactic Holdings, trading as SPCE, is currently closed for the regular session as of Monday, December 22, 2025 at 4 p.m. EST. The stock finished the day at 3.76 USD, marking a significant upward move of plus 0.26 or 7.43% from its previous close. While a 7% jump usually signals a massive breakthrough in the aerospace world, the reality for Virgin Galactic is much more complex than a single day's green candle. Most investors see this price action and assume the countdown to commercial flight has finally hit zero. But the actual driver behind today's movement isn't a rocket engine. It's a balance sheet overhaul that just bought the company a massive amount of breathing room. While the crowd is watching the launch pad, the real story is happening in the accounting department, where a major debt restructuring has effectively reset the clock on Virgin Galactic's survival. The market expectation for SPCE has long been a binary outcome. Either they build the Delta-class spaceships and become the premier name in suborbital travel, or they run out of cash before the first weld is finished. For months, the narrative was leaning toward the latter, with the stock price scraping multi-year lows. However, the reality we're seeing today is a company that has successfully navigated a high-stakes financial tightrope. By repurchasing over $350 million in convertible notes and replacing them with a more manageable debt structure, management has signaled to the street that they aren't going anywhere. This move has forced a lot of short sellers to rethink their positions. When you see a 7.43% spike on a day with no flight news, you're looking at a relief rally. The pressure cooker of immediate bankruptcy has been vented, and now the stock is starting to reflect the value of the time they've just acquired. This kind of volatility is exactly why so many people are turning to an online investment strategy that balances high-risk individual stocks with more stable assets. If you're managing your own capital through a Fidelity brokerage or a Robinhood app, you know that the space sector is notorious for these hurry-up-and-wait cycles. While the casual observer might just see a cheap stock price and think it's a bargain, the seasoned trader looks at the institutional activity. We've seen a recent uptick in positions from some of the largest asset managers. These aren't necessarily diamond-hand believers in space tourism. They are often algorithmic inflows or strategic hedges. For those using Schwab Intelligent Portfolios or similar automated tools, SPCE likely doesn't even show up on the radar because of its high beta and lack of earnings. But for the self-investing crowd, this 3.76 level is a critical psychological line. The recent movement is driven by a series of capital realignment transactions that were finalized just days ago. Virgin Galactic managed to reduce its 2027 debt obligations from $425 million down to about $70 million. That is a massive reduction in future liability. To do this, they used a combination of private placements and a new series of first lien notes. Yes, the interest rate on the new debt is high at 9.8%, but it moves the maturity wall further out to 2028. In the world of pre-revenue aerospace, time is the only currency that truly matters. If you're checking your Robinhood investments today, you're seeing the market reward the company for surviving its own debt schedule. It's a classic case where the expectation was a looming liquidity crisis, but the reality turned out to be a savvy, if expensive, refinancing. Let's talk about the trading volume and technicals for a moment. We saw over 8 million shares change hands today, which is a healthy bump over the recent average. This indicates that the move to 3.76 wasn't just a thin market fluke. There is actual conviction behind this buying. On a technical basis, SPCE has been trapped in a brutal downtrend for most of the year, underperforming compared to the broader tech sector, where Tesla stock and Nvidia stock have been grabbing all the headlines. While the investors were busy watching Apple stock hit new milestones, Virgin Galactic was quietly rebuilding its foundation. The stock is currently trying to establish a base above its 50-day moving average. If it can hold this 3.76 level through the end of the week, we might actually see a trend reversal that isn't just a dead cat bounce. For many who use Interactive Brokers Trading or a SoFi active investing account, the temptation is to treat SPCE like a lottery ticket. But look at the institutional ownership. Vanguard and BlackRock still hold significant chunks of this company. They aren't playing the lottery, they are holding a diversified basket of future tech. Even within Fidelity mutual funds or various Fidelity ETFs, you'll find small exposures to the aerospace and defense sector that include names like Virgin Galactic. It's a reminder that while the retail crowd on the Robinhood trading platform might be looking for a quick double, the big players are looking at the 2026 and 2027 timelines. The Delta-class ships are the make-or-break catalyst. The company expects the first of these new vehicles to enter flight testing in early 2026, with commercial service starting later that year. Until then, the stock is essentially a proxy for investor patience. Comment below how many shares of SPCE you currently hold, or if you've moved your capital into safer havens recently. I'm curious to see if the community is still holding on to the dream of suborbital flight, or if the long wait has pushed you toward more traditional investing sites. When we look at the business model, Virgin Galactic is essentially an airline that hasn't started its main route yet. Their older ship, VSS Unity, did its job. It proved the technology works and showed that there is a line of wealthy individuals willing to pay $450,000 for a few minutes of weightlessness. But Unity was never meant to be a profit engine. It was a prototype for a larger vision. The Delta class is designed to fly up to 8 times a month. That is the reality that needs to exceed current market expectations. If they can hit that cadence, the economics of the business shift from a cash-burning experiment to a high-margin luxury service. The current market cap of around $237 million reflects a lot of skepticism that they can actually hit that 2026 target without more dilution. Past performance has been a sore spot for long-term holders. If you look at the chart over a 5-year horizon, it's a painful sight. The stock has shed over 90% of its value from the peak. Much of that was due to the reality of how hard it is to build a space line. Engineering delays, regulatory hurdles, and the sheer cost of aerospace manufacturing have repeatedly clashed with the optimistic timelines provided in earlier years. This is why the expectation for the stock is so low right now. When the bar is on the floor, even a simple debt restructuring can cause a 7.43% rally. The market is so used to bad news from SPCE that the absence of a disaster is treated as a major victory. Macroeconomic pressures haven't helped either. High interest rates are the natural enemy of companies like Virgin Galactic that rely on future cash flows. When you can get a guaranteed return on a savings account or through a SoFi investing robo-advisor, why would you risk your capital on a company that won't see real revenue for another 18 months? However, as the Federal Reserve begins to signal a shift in policy, we're seeing a rotation back into long-duration assets. These are stocks that represent the future. While most people are looking for investment help to find the next big AI play, there is a contrarian argument for the space economy. If the cost of capital drops, the math for building a fleet of Delta-class ships starts to look a lot better. If you're checking your Robinhood app for your daily gains, it's easy to get lost in the noise. But the institutional activity we saw in Q3 and Q4 of 2025 suggests a quiet accumulation. Firms like D.E. Shaw have actually increased their stakes. This tells me that the smart money is looking past the 3.76 price and focusing on the 2026 flight testing program. They are betting that the reality of the Delta class will be far more impressive than the current skeptical narrative. It's a classic setup. The public is bored or frustrated while the institutions are positioning themselves for the next cycle. The business model itself is shifting toward a more industrial scale. They aren't just selling tickets to celebrities anymore. They are looking at research missions, payloads for government agencies, and even high-altitude testing for technologies developed at places like Lawrence Livermore Laboratory. This diversification is key. If they can prove that their ships are reliable platforms for science, the revenue ceiling goes much higher than just tourism. This is the kind of depth you won't find on simple investing sites that just list the daily movers. You have to look at the partnerships with companies like Redwire to see how the infrastructure of the company is maturing. For those managing an individual brokerage account, the question is always about opportunity cost. Should you hold SPCE, or would that capital be better served in a SoFi active investing portfolio focused on more immediate earners? The tension between expectation and reality here is extreme. The expectation is that space is too hard and too expensive for a company of this size. The reality is that they have over $400 million in cash, a significantly reduced debt load, and a factory that is starting to receive 90% of the parts for its next-generation ships. If they hit their Q3 2026 flight test window, the current